So we hit peak industrial production in 2008, and almost nowhere has it gone higher. The US industrial production has been sideways ever since. And many nations, particularly in Europe, it's actually gone down. Germany's down, the UK's down, Spain is down, Italy's down. These are really bad things. So our productivity has declined. Our trend rate of growth has declined. Asset prices keep rising, but they're unaffordable for all of us.
The world stopped in 2008 when the banking and real estate industries completely imploded due to the insane amount of leverage in the system. The complete meltdown of the global financial system was very nearly the end of the monetary system as we know it today, until central banks came to the rescue by announcing multiple quantitative easing rounds. According to Real Vision founder and CEO Raoul, 2008 was supposed to be another 1929 moment, but for the timely intervention of the then Fed chair Ben Bernanke, who had an understanding of what went wrong during the Great Depression and how using the Fed's balance sheet to deflate the value of money can save the system. That's exactly what the Fed and every other central bank did. However, their solution was only temporary. What they did optically increased asset prices and saved the system, but that policy became irreversible forever. The first round of printing and every other round after that led us to this very moment when it has become impossible for the system to self-regulate and survive on its own without central banks printing more money to prop it up. According to Powell, the singular obligation of the Fed and other central banks now is to prop up the baby boomer investor complex, because if it goes, the whole system implodes again, and everything will be reduced to an extremely chaotic environment. Powell believes the boomers are at the very heart of the problem because of their sheer number. To begin with, they caused the inflation of the 1970s when they started entering the workforce and competing for goods and services, and the turbulence of the 80s when they started buying financial assets. Then, the WTO agreement allowed in more workers and investors from other parts of the globe, rapidly increasing asset prices, causing an insane amount of leverage in the system before everything got out of control in 2008. So, all money printing exercises now are just an effort to add another band-aid to the massively wounded system, which ironically further worsens the situation. Yet, central banks cannot stop slapping on band-aids. Powell's conclusion from all of these observations is that the system is completely screwed, and every one of us right along with it. In a recent video, the renowned macro analyst and former Goldman Sachs executive vividly describes the entire problem, outlining how we all became debt slaves and the only solution to the problem. As we bring you clips from the video, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this.
All the central banks agreed pretty much around the same period of time to start printing money, debasing all of fiat currency. Asset prices ripped. If asset prices ripped, well, guess what? The collateral of the system is now saved. So they save the system via this particular mechanism. Now, these are optics. They're not reality. They're optics. And I've spoken before, if you divide any of the assets since 2008 by the Fed balance sheet or global total liquidity or any one of these measures, they've gone nowhere. That whole fiat currency debt-driven bubble regime died in 2008. And GDP globally fell. The trend rate of GDP growth ratcheted lower and never rose. But you see, more things happened after 2008 that people aren't really aware of. For example, the dollar has been rising since then. Why? Because the dollar is the global reserve currency, most of the global debts are in dollars, and there's a shortage of global dollars, and there has been since 2008, and really exacerbated by the time we got to the European financial crisis. So there's a shortage of dollars, there's a shortage of global lenders because of Basel III and the agreements with the banking system. So the dollar rises. Okay, fine, we can deal with that, and that's part of Brent Johnson's dollar milkshake theory. But more importantly, when we look at global equity markets in dollar terms, they haven't gone up. See, here's the MSCI world. It basically hasn't gone up since 2008. When we look at, let's say, a country like Spain in Europe, Spain, I was there over that period of time. It was a terrible situation. Spanish stock market in dollars hasn't gone up. Italy, dollars, hasn't gone up. The Euro stocks in dollars hasn't really gone up. The FTSE in dollars hasn't really gone up. MSCI emerging markets they've gone nowhere since 2008 in dollar terms. And the same with Shanghai. So the Chinese equity market or the Bloomberg commodity market peaked back then. There's only a few markets that have outperformed this. And those are the ones that I've talked about in the past. Those were technology, crypto. You could argue India as well because it's different demographic cycle. But not only did equity markets peak in 2008, but we also peaked in total debts. So really what we've seen is debt market has peaked. The US debt market peaked. In the pandemic, we had that extra spike, but really it peaked a while ago. And I've talked about this before, and I'll come on to this in a bit, is the debt growth now is really just offsetting the interest payments. And it's all around trend rate of GDP growth. So therefore, debt is not growing faster than trend rate of GDP growth, really, because it's the missing trend rate of GDP growth that goes into paying the interest payments, and the interest payments are where the debt growth is. Those are the deficits that we see. So we've now been fucked because asset prices are rising and we can't borrow money to even get into the property market, but they're also becoming unaffordable because our wages never went up. Okay, so those are the two of the key reasons why we're fucked. Now, what we need to do is figure out, okay, what does this all mean? Now, what I've shown from all of this is that really the governments have just offset the debt growth via the printing of money. And the balance sheet keeps going up. And that is the debasement of currency effect that is so pernicious. You've got to think of debasement of currency as a hidden tax on everybody. So we're all unable to afford any of these things, and they have just monetized all of the differences here. We've all become debt slaves because it's been mutualized to all of us. They could have increased taxes by 15%, but they didn't. They did it this way. Now, that's also made the rich get richer because they can own the asset, and the poor get shut behind it.
A lot of things got badly damaged during the Great Financial Crisis, and the future of billions of people globally was permanently altered. Yet, the rich got by just fine. In fact, they didn't just survive without permanent scratches like the rest of us. They got richer and stronger, just as the poor got poorer. According to Forbes, the number of billionaires in the world topped 1,000 for the first time in 2008. The world's billionaires had a combined net worth of $4.4 trillion in 2008, up from $900 billion from the previous year. In 2022, that figure hit an astonishing $12.7 trillion. In addition, a 2019 report published by Capgemini, a multinational IT services and consulting company, found that the world's richest people more than doubled their wealth between 2008 and 2019. According to the report, the combined wealth of the world's millionaires and billions hit a record $70.2 trillion in 2019, more than double the 2008 figure of $32.8 trillion. Another report from Oxfam found that 131 billionaires more than doubled their net worth during the pandemic. At the same time, almost 10 million people were pushed below the poverty line, earning less than $1.90 per day. Global inequality has continued to widen with every QE announced by central banks, making the rich stinkingly richer and the poor even poorer. Let's get back to Pal's video as he speaks further about the issue.
But the other thing that we have hit is peak humans. You see, if GDP growth is driven by population growth, productivity growth, and debt growth, I've just explained that debt growth broke in 2008, not coming back. Population growth also peaked back then too. It started peaking in 2000. And what we've seen is things like the labour force participation rate fall. And this is the bigger story, the demographic story behind which this is all driven. Peak humans have created the problem of lower trend rates of GDP. Peak humans are what we face in our future. So the labour force participation rate in the United States, as the number of people who are active in the labour force, has been declining. So that means there's less productivity because we've got this aging population. Also, there's less industrial production because less people are in the labour force. It kind of makes sense, right? So it's a problem that is going to continue because when we look at forward-looking elements, the working age population in the US has been falling over time. Most countries in the world are actually shrinking now of the major developed economies. With everybody's major economies all shrinking in population, it means their trend rates of GDP are declining, industrial production is declining. But what I found as part of the everything code was that actually Once you strip out all of the complexity of markets, there is one thing going on. Government debt is just being created to offset the aging population. This chart, I think, is one of the most stunning charts I've ever found. I've never seen it anywhere else. Most of my Everything Code thesis doesn't appear anywhere else in the world. It's all proprietary research. And this simple chart says a lot. So if you get your heads around that, government debt's percentage of GDP is basically driven by demographics. So as the population ages, growth slows, government debt increases because they're having to pay the interest on the debt to offset the growth that's missing. It's trying to keep the system together. Now, not only that, but if we put the Fed balance sheet against the same chart, we've got the same thing. So the Fed balance sheet is really a function of population. So the older the population gets, the more they debase it. And as we go into the future, you can see that this is a one-way trend into 2035 and beyond. Demographics are destiny, and the demographics are going to continue to decline. So that brings down trend rate of GDP, it increases government debt to GDP, and it increases the use of the balance sheet. So once you understand that, you understand the game that's been playing here. The other one chart that's really interesting is demographics are inflation. So when we look at the inflation in the United States, the core CPI, it's basically births, deaths, but there's obviously that COVID spike. I think we'll revert back to the normal trend. I don't see how that changes. And then obviously the classic Everything Code chart, which is the Fed balance sheet versus the interest payments. And we're about to go up that wall of interest payments. Either the government ends up with record debts and the bond market breaks, or they have to do something. Yield curve control or just general printing of money. But you see, everything did break back in 2008. Peak population growth created these problems going forwards. And we're seeing the central banks now doing one thing and one thing only. In fact, I think the governments are doing one thing and one thing only. And once you understand this, you understand everything that has happened and why the world is like it is today. Their entire job is to keep afloat the great baby boomer investment complex.
According to Raoul, the global equity market can simply not be allowed to collapse. And the only way to ensure that does not happen is for central banks to continue to prop things up at the tiniest hint of trouble. This is why Powell has been skeptical of predictions of a widespread collapse over the past year. Despite the unprecedented rate hikes and calls for a nasty recession from all quarters, Powell has remained resolute that we are not going to have anything of such. While he agrees, like every other investor, that the system is completely screwed, he is certain that the money printing will keep things steady for a while longer until a more permanent fix to the problem can be developed. According to the former Goldman Sachs executive, artificial intelligence and robots can easily solve the world's demographics and productivity problems. However, he believes the immense power of these and other disruptive innovations will not be fully unleashed until 2030. Before then, Powell advocates making the best decision for your portfolio by investing in crypto and tech stocks, the only asset classes that have managed to outperform the Fed's balance sheet over the years. Do you agree with Powell's analysis that we can somehow find a way out without any lasting damage to the financial system? Please drop your comments and observations in the comments section below. Also, ensure you subscribe to the channel and turn on post notifications for more videos like this. Thanks for watching.